Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. This is going to be a very quick, distilled version of my usual videos, so please stick around to the end. I'm going to cut out all of the fluff and just focus on the important things. So let's start with market performance. The S&P 500, NASDAQ, and the Dow all closed very slightly down on the day yesterday. The NASDAQ basically closed flat. Let's take a look at the different groups. Leading by a very wide margin was energy and basic materials. The laggards were real estate, healthcare, and communication services. Everything else really was in the middle. Let's take a look at the stock market map. Right off the bat, we can see that energy enjoyed massive gains yesterday, largely due to the news that I covered yesterday that came out of Saudi Arabia, where they talked about cutting production if the futures markets continue to show a disconnect between the actual supply-demand dynamics globally, would show a very tight market, and the futures market, which is actually significantly underpricing oil. Tesla was also a notable outperformer, and I did say in yesterday's video that Tesla looked like a much stronger play than the NASDAQ. It is very rare to see the NASDAQ sell off and Tesla sell off less than the NASDAQ, and that's what happened. We saw a relative outperformance with Tesla versus the NASDAQ, the triple Qs. Now let's jump straight into the daily chart for the S&P 500. Again, guys, things are playing out pretty much as we expected and as we talked about yesterday. We're seeing a significant slowdown in this rally after we hit the lower expected move for the week at $413.50 on Monday. We did say that when the market hits the weekly expected move on the very first day of trading in the week, you can expect that this level will actually act as support and that the market will likely try to make a bounce. We're getting very, very close to filling this gap at $411 right here. So I actually expect that we will fill that gap today and probably start to head back up possibly today or tomorrow after those GDP figures and job numbers come out. Watch for a revision to the upside on GDP and watch for strength in the jobs market, both of which will help the market make a small bounce. Now, the logical level to expect the market to bounce to, guys, is right over here at $422. This sits smack in the middle of the weekly expected move, and it's also the level at which we will fill this gap. Now, interestingly, guys, on the 1 hour chart, I'm starting to see some very minor bullish signs. This bullish crossover on the PPO is interesting. The way that this will probably play out, guys, is for the market to make a new low today and actually form a divergence on the 1 hour chart, where the PPO actually makes a higher low while the market makes a lower low, completes this gap fill, and forms a very short-term base where we could see the market start to move back up. Now, this thesis is backed up by some divergences that I'm seeing between the S&P and the IWM, for example, the Russell 2000. Remember, guys, what I said about the Russell 2000 in my crash warning video. The Russell 2000 tends to top before the rest of the market and tends to bottom before the rest of the market. So it's somewhat of a leading indicator, and we're actually seeing a higher low on the IWM as compared to the S&P. I'm also seeing a higher low on the HYG, the high yield bonds, the junk bonds. So I'm starting to see some very small divergences. It's so funny that in yesterday's video, I actually said to look for a divergence between the HYG and the S&P. That's exactly what happened. It made sense to me because we had this 50-day moving average, which would make total sense for this 50-day moving average to act as support. We also hit the weekly expected move on the S&P. So both of those really small details indicated to me that we will probably start to see some divergences before we attempt to bounce back up. Let's take a look at the triple Qs. Same thing on the triple Qs, really. We're starting to see some very minor outperformance of the S&P. So we're starting to see some risk taking, right? Because the triple Qs are considered a higher risk product than the S&P. So when you see a outperformance by the triple Qs as compared to the S&P, it indicates some riskier positioning. So it appears that market participants are preparing for a bounce back up. So it looks like they also agree with this thesis that we might see a bounce back up and a close of this gap right here above at $322 on the NASDAQ. The VIX is starting to slow down after having that explosive move to the upside. Please guys check my previous video where I talk about these signals right here. Every one of these signals has been absolutely perfect in predicting stock market tops and significant sell-offs. In fact, this signal so far year to date has had a 100% track record of predicting sell-offs and marking stock market tops. So this signal has been playing beautifully for us. Please check out my previous video where I talk about this. Now, what tends to happen after this initial signal is triggered, we tend to see the volatility move up and then slow down before the next leg of the sell-off, right? This happened here as well, and this happened here as well, and here. Okay, so this happened every single time this signal was triggered, except for the last time it was triggered, which marked the year-to-date stock market bottom in June. So I do still expect volatility to move sideways for a few days now, especially when we have very significant economic drops. Thursday we have the GDP and jobs, and Friday we have the Fed coming out in Jackson Hole, and we have the dreaded, awful PCE inflation print. Remember guys, PCE is the preferred inflation measure by the Fed, especially core inflation, core PCE. So we have a major market moving event on Friday. Again, this makes sense as to why the selling is now taking a break. We tend to see stuff like this where we get a massive dump and then the market takes a break, waits for the next event, and then makes a decision either to the upside or to the downside. Let's take a look at the dollar index. Again, the dollar index has been playing out beautifully for us. I talked about the dollar index right back here. I said watch for a break above 107 right over here. And boom, look at that. As soon as that happened, we saw a significant spike in the dollar index and a massive sell-off in the stock market. The dollar index is now slowing down, possibly forming a bull flag. We will see. But this pause in the dollar index will help equities try to float back up at least for a couple of days. Let's take a look at Apple. Again, this was an insane move in Apple, right? From the June lows to the top, we had a 35% rally, absolute insanity. The last time we saw something like this was unfortunately in the 2008 bear market. And this is very typical of Apple. It tends to outperform the stock market for a long time, right up until the very end, where all of that outperformance evaporates in a matter of a few trading weeks. And unfortunately, all of those traders and investors who were hiding in Apple get really burned by that last sell-off. I do not like Apple as a long trade at these levels at all. But again, expect it to trade around the S&P and the NASDAQ over the next couple of trading days. Let's take a look at Tesla. Tesla is doing way better than the rest of the NASDAQ. It is now outperformed the QQQs, the NASDAQ, throughout this sell-off, right? I did say in the last few videos where I covered Tesla that we need to see buying off this level, off this pivot level. And we're starting to see that, so this is a massive check mark for the bulls. With that being said, guys, still we have to be very careful because a sell-off, a broader sell-off in the S&P and the NASDAQ will unfortunately also drag Tesla down. But so far, Tesla has outperformed, which is atypical because Tesla is a high beta stock. And what that means is that we tend to see exaggerated moves in Tesla as compared to the NASDAQ. So for example, if the NASDAQ moves up 1%, we're used to seeing Tesla move up 2%, and when the NASDAQ moves down 1%, we're used to seeing Tesla move down 2%, basically a 2x move of whatever the NASDAQ is doing. That's typically how Tesla behaved over the last couple of years. But the last few days, we're seeing Tesla actually seeing significantly more conservative drawdowns than the rest of the market. Now let's take a look at ExxonMobil. I've been following and talking about this stock a lot. In fact, last week, guys, I talked about this very unusual accumulation that I was seeing in ExxonMobil. A lot of people were actually waiting for the energy sector to to show more cracks for the for oil as well to continue to move to the downside. I disagreed with that at the time. I still disagree with that. I think the oil market, the energy market is much stronger than a lot of people think. So I'm still bullish on inflation, on the inflation trade, especially around energy. And so, yeah, we did notice this accumulation here, guys. This was very sneaky, right? We were seeing buying, significant buying. We had 6, 7 days in a row where the stock closed higher than the open. And when you see stuff like that, guys, it indicates that people are buying. So there was buying in the stock when it was moving sideways. That was very sneaky, and I noticed this massive, absolutely enormous bull pennant, right? A bull pennant is very much like a bull flag, but the difference is that while a bull flag has a flagpole and then a rectangular flag, a bull pennant has a flagpole and a triangular flag. And I tend to like pennants more than bull flags because when the breakout ends up happening, you see a massive move to the upside. A significantly more violent move than the typical bull flag. And the psychology behind this, guys, is that price expansion leads to contraction and contraction leads to expansion. And so over the past few days, I've been watching this like a hawk. I've been waiting for a break above this resistance line, and look at how violent this move was. As soon as we had that break above, we had actually a very sizable gap and go, right? We gapped and went and ripped to the upside, and I caught this move right at the open. I opened a position, an options position that is actually now up, I think around 25%. It's a long dated option position that expires in November. Some other members in the Discord group banked 40%, some 30%. It really depends on how you structured your trade. I structured it much more conservatively, but still my risk to reward is 6 to 1. 6 to 1. My return on this investment, I expect a 6x return. So 500% plus. And I structured it very conservatively. If you went crazy with this trade, you might expect more, but I prefer to go more conservative and lean more towards a higher win rate than a high risk trade. If you guys want to follow my trades, I do post every single trade and investment that I make in real time in the Discord trading community. It's 20 bucks a month. If you want to support me, that's the best way you can do that. And you get access to all of my trading and investment activities, my trade ideas, my setups, and go over strategies, risk management, etc. So everything I do is in that Discord group. If you're interested, check out the link in the description below. Now let's jump into the fear and greed. We're sitting at a neutral reading. We have not seen a fear reading just yet. Let's take a look at the timeline. When we were moving up right back here, I did say to expect a top around the 58 reading. We ended up topping around 57. The way that I concluded that we should top around 58 is that if you connect a resistance line, we would have needed to see a top around 58, roughly 58, for the bear market thesis to stay intact. And that ended up happening almost exactly. We topped at 57. We're now moving down. And right here on market momentum, we had a very significant pullback to the 125 daily moving average. The last time we saw that, we actually had a bounce back up. So again, this also lends credence to some of the divergences that we're seeing with momentum, with the HYG, with the IWM that are indicating that we could see one last attempt for a bounce back up. Stock price strength is still weakening, breadth is still weakening, put to call ratio hasn't peaked yet. We should see somewhat of a slight break to the downside, where we see that bounce back up, that small rally, and then we should see the market make its decision on Friday and Monday after the Jackson Hole and after the PCE print is out. And more than likely, what I expect, guys, is that for us to see a bounce back up, trapping a lot more bulls in a fake dead cat bounce, and for us to continue to sell to the downside. Market volatility, again, guys, we're approaching the 50-day moving average. We had a few times in the past where we hit that 50-day moving average, and then we saw consolidation, some pullbacks in volatility. Again, this guys lends credence to the thesis that we could see some sideways movement, similar to what we had here, here, and here before the next leg of selling. Safe haven demand is growing, right? Bonds are outperforming stocks. Junk bonds are getting sold off versus investment grade corporate bonds. Again, so the long-term bias is still very bearish. The very short-term bias is starting to turn very, very subtly towards a small bounce back up. Let's take a look at the economic events that we have coming. Today, we'll have the durable goods orders and core capital equipment orders. Tomorrow, we'll have the jobs numbers and GDP. Again, watch for a revision to the upside on GDP that will unfortunately lead to higher inflation, so expect even stronger rips in energy and basic materials if we see a revision to the upside in GDP. Friday, we have PCE, we have consumer spending, we have personal income, we have the 5-year inflation expectations, consumer sentiment, Fed Chair Jerome Powell. Friday is going to be an insane day. So what I'm hoping for is that for us to see that bounce back up to fill the gap at 422 by Thursday, hopefully. So people can close their long positions, and so that we can observe Friday and make our decisions on Friday. So I'm hoping that we will see a move back up to close this gap before Friday, but more likely than not, the market will actually make that big move on Friday, right? So a rip to the upside on Friday, close this gap, perhaps overshoot the gap, hit the resistance line one more time. Everybody goes rah, 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 bullish, bullish, bullish. Jerome Powell is very dovish, etc., etc. And then on Monday, we see a massive dump. That's usually how things play out around these events, guys. What ends up happening is that the market reverses exactly one day after the event. So if you see a massive move to the upside on the day of the event, of the economic event, or whatever it is, in this case, the Jackson Hole meeting, we see a massive reversal the next day. So usually the first move is a fake out. The next move is the real directional move. So we'll see. I'm hoping for a gap close by Thursday. If we don't get that, if we get that on Friday, unfortunately, a lot of people will get trapped in this move. Please do not be one of them. Be very careful, guys. Manage your risk. Do not FOMO into this market. Watch for a very clear directional move and for a confirmation the day after. So wait for Monday if you want to go bullish, and same thing if you want to go bearish, wait for confirmation. That's all I have for today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye. Oh, wow.